So yeah, this question came in from Anna via email on Relic Health Technologies Inc. (RHT) on the TSX Venture. It's currently trading at a price of, well, it's halted right now at about 21 cents or 22 cents. Has a market cap of 41 million, and the company is a telemedicine provider that provides virtual care solutions for the healthcare market, and it offers its iUgo care platform, a software as a solution that allows patients to receive care in home. So, to remind listeners, yeah, we have reviewed Relic a few times on the podcast. Once in 2018 as a dog when the stock was down 85% over the course of that year because the company was, putting up severe losses on some of the contracts that it had recently secured. There was optimism around those contracts. They didn't really turn into profits. And keeping in mind at that time, the business was completely contract driven. Then in September of 2022 and again in August of 2023, we reviewed the stock as a Your Stock Our Take segment, considering the company had switched from primarily a hardware business to a software as a service model in 2021, and it was showing good revenue growth but no profitability. And since I covered the stock last in August of 2022, the stock is down, or 2023, sorry, the stock is down 55%. So, what is driving the stock lower? Well, number one, Relic's last quarterly financial results were reported back in May of 2023, which was for Q3 ended March 31st of 2023. And these were the financials that I reviewed on the podcast over 6 months ago. And I did say at that time, revenue was showing good trajectory and they were just breaking into profit, which was good to see at least. Um, However, though, the company ended up announcing on October 31st that it was unable to file its audited annual financial statements and expected to file them on November 14th. The November deadline went by without any results, and the company then announced that it expects to file its annual filings on or before January 12th of 2024. But this date also passed. So currently outstanding are both the annual financial results, which are for the period ended June 30th of 2023, as well as Q1 of 2024, which was for the period ended September 30th, 2023. And as a result of the missed deadlines, the Canadian Investment Regulatory Organization placed a temporary trade suspension on the stock, which is still in place right now. Now, number two on what is driving the stock lower, just further dilution. Management stated in 2023 that they expect strong growth in 2024 and that it did not expect to need to raise capital or take on debt to fund operations. However, as I predicted would likely take place given the negative cash flow, on October 5th, the company raised about $6 million for 15 million shares, which now places the company's outstanding share count at above 220 million shares outstanding. And I'm just going to leave this YouTube comment up on the screen here from Josh Jordan, as it aged quite well, or at least for me, in relation to my prediction that the business will have to continue to dilute to keep the lights on. And he says they will not need to dilute more shares to keep the lights on. They will not need to do that. They have more cash on hand and will most likely buy shares back in 2023. Well, that didn't happen. So going to the other reason why the stock was down. So while all this has been going on, there's been a bit of a shuffling with management as the CEO, Dr. Lisa Crossley, resigned for health reasons. And then they brought in a new CEO or interim CEO, Chris Shields. So overall, uncertainty is definitely heightened at this point and is essentially why we have seen the stock lower by over 50% in the past 6 months. But as I said in August, I think that it will be crucial to ensure the business can maintain its slight profitability achieved in Q3 of 2023, which was, reported almost a full year ago now. But clearly, investors of Relic remain in the dark, and we have no idea if the company will continue on its path of, profitability going forward here. So yeah, that's Relic. Not a great story for shareholders at this time. And again, I need to make clear this is not a recommendation. I've been steering clear, or I've been telling clients to steer clear or not even clients, listeners, to steer clear from this stock, just because, again, we've seen good revenue growth, but we need to see that actually translate into profitability. They've announced so many of these large contracts, but again, until the company can make consistent profits, we just aren't sure about the business model.
Yeah, it's a good summary. I mean, our basic criteria is cash flow, profitability, and there's some revenue growth, but we haven't seen the cash flow that we need to see on a per share basis grow to drive the share price higher. And there's also some other issues obviously going on here with the business not filing.
Yeah.
That it's hard to comment on what exactly is going on there, but it's the overall numbers don't meet our criteria, and then when somebody asks about it, that's all we can comment, that it just doesn't meet our
Yeah.
criteria, which includes profitability, because what we're trying to do is protect against some of the downside we've seen in this company from where it was at its highs,
Hmm.
when you don't have that underlying cash flow supporting the share price. All right, do we have any other comments on Relic, or I think we basically beat that one,
Yeah, I
beating a
think it's
dead
good.
horse, right? Yeah.
Mhm.
Okay.